Hey, what's happening, guys? Dan Darrow here with another Options in Play video update. Before we jump into the video and the stock and AMD, uh, I want to first off, just say I hope everybody had a great long holiday weekend, and Kurt and myself, we are really looking forward to a busy few months to close out this year here. It's going to be a busy stretch. Um, so for the Facebook Live videos, we want to try something new. Uh, if you guys want us to talk about a trade or a setup or even something just real basic options related, we had a video last week just about call flies. Just something really like super basic. Send over the idea, follow up, send an email over, and we're definitely going to try to focus some of our videos on tackling those topics. I'm sure you guys have, a ton of questions, or you want to hear about certain names. So please send over those ideas, and we will try to get the videos out to you guys, as quickly as we can. So cool. So yeah, back to today's video. It's going to be about AMD, and this is really a great recent example of why options rolling, or what is really trade management, is actually different than stocks, and this is really like a good. It highlights why it can be so rewarding. So, um, you know, AMD is a great recent example, but it really seems like every week there's a stock that has just an incredible move, which just either running or dropping way past anyone's expectations. You know, some story that retail investors fall in love with, or major technical move, or big fundamental development. Whatever the reason, thing just takes off and just goes way past what everybody was expecting, and traders will say that they caught some of the move, but left so much money on the table, right? I'm sure it's happened to you. I'm sure you've known people that it's happened to also. Uh, AMD, when we got into the trade, obviously, we were hoping that it would have moved like this, but can honestly say that we probably weren't expecting such a big move. Uh, what This was a name we were riding for a while, and just on the most recent, so like after earnings, it had a pretty nice run up to 20, and this has been kind of one we've been in and out, rolling, been managing a few times, but the most recent trade here, what we were focused on was this action, this really tight pennant forming at 20 post earnings. I mean, it topped out at 20, pulled back, and then just rising support, creating like this really tight pennant. And towards the end of August, we were just waiting for what we call that igniting bar, which like the stock looked like it could have an explosive move, but it couldn't really get through 20 with authority, and really get that volume surge to really like send the stock like running. Uh, but then finally, you could see it started to tick, and then even like this day, not really so much. It was this move on the 23rd where the volume really started to accelerate. You can see down here, volume started to accelerate, and the stock really broke out. And actually, I mean, that was so this day. So when it got up to 22, that actually hit our 10% measured move target through 20. So at the time, it was a September 21st expiration, 20 to 25 call spread. And that's when we actually thought it was a good idea to close that out, because this was a long hold. We were in it, through earnings, and then another 10% through 20 happened pretty quick. So we decided to roll up. Uh, so once closing out that 20 to 25 call spread, we like when we roll up, we like to target a contract that is similar, basically, more or less around like the original debit of the previous trade. So in this case, the September 21st 2250 call, the debit was close to the original amount of the September of the 20 to 25 call spread. So we decided to roll up into that contract. And let's talk about why what we that rolling strategy was different than owning the stock. So let's say, for instance, you had 100 shares of AMD when it broke out, right? Just for argument's sake, we'll say 100 shares of AMD, because that's the equivalent of like one call. So say you had 100 shares of AMD when it broke out, and when it got to 22, you wanted to take money off the table, right? What are your options if you just are trading the stock? Basically, the only way you can take risk off the table or lock in money, right, is to sell some of those shares. So, for instance, say you wanted to, lock in half of those shares, and you're selling 50 shares, so you have 50 shares remaining. But now, when you think about it, your net upside exposure is half of what it was. So instead of 100 shares for every point it runs, now you only have 50 shares for every point it runs above. And let's compare that to what we were able to do with options, right? So you had the 2025 call spread. You were able to, when it hit 22, you were able to lock in some money, roll up to 2250 call, right? That was close to the original debit. But now when you think about it, you actually still have 100 shares of net upside exposure, right? Because like one call would be 100 shares. So if you had the stock, you only have 50, but now when you're able to roll with options, you still have basically that same net upside exposure. And we didn't know that AMD was going to go parabolic. Obviously we were happy with that, but we weren't necessarily anticipating that. But when it did, it gave us the opportunity to unload that 2250 call again once it broke above 25, and roll up a third time just in the last month. So now think about it again from the shares perspective. If you own the stock, so you sold 50 shares, for instance, at 22, and then when it got up to 25, you sold more. So then you're at the point where it's like you maybe only have like a quarter of the shares left, or even less. And the stock is still running, but your upside exposure keeps getting less and less and less, and the stock is still pushing and pushing and pushing. And when it comes to shares, it's like, if you sold at a lower price, odds are, you're going to be a little bit more reluctant to buy at higher prices. But with the options, you can cut risk back, and then like roll up to a contract, less debit, but still give you that upside exposure. So it's not as if you're chasing, because you keep cutting the risk back as it moves, but you still have like that same amount of exposure, like 100 shares. Just in this, for this example. And if AMD keeps going, that's great. You keep riding. You just keep rolling up. Taking risk off, rolling up, and it really, it's just a great example of why we feel like options trading can really be different than equities. There's differences in a lot of things, but really like this trade management rolling thing is one that we like to highlight to people as why it really can be really, really attractive when it comes to trade management. So yeah, I mean, for all of you guys just getting back after vacation, definitely be sure to check out the new options education material. It's just launched in the last couple of weeks. The link is in the video title to this video. So the option education material, it goes over basics, event strategies, just regular strategies, the Greeks, basically everything we feel you need to know to become a better options trader. So definitely be sure to check that out. So have a fantastic night. Again, following up, like if you guys want us to talk about a specific setup, a stock, something in the videos, reach out, let us know, and we'll try to get those videos together for you. All right. So have a great night, and we'll talk to you guys all soon.